Hello everybody. Welcome back to this webinar session on the paper F6 or the taxation paper Pakistani variant. Myself Luqman Rafiq, um, as we had an introduction in the session yesterday also, I am the tutor for this specific webinar that is being conducted. So what I'm actually going to do is that I'm going to have a quick recall of what we did discuss in the yesterday's session, and then I'll let you know that what exactly are we going to do in today's session. So in the yesterday's session, what we did was we started off discussing about the background of this specific paper taxation Pakistani variant. I discussed about the variant laws and regulations which are applicable. I discussed about how the exam sessions are being conducted by ACCA, what is the approach to examining of the syllabus, and then I did discuss about the syllabus also. Later on, what we did was we talked about the syllabus areas, and then we talked about the day-wise plan. So in the yesterday's session, what we did was we started off with we actually started off discussing about the basic concepts which are essential in order for us to do the taxation. So what I did actually was I discussed the basic concepts, and the first concept that I did talk about, that was basically the concept of tax year. We talked about that what exactly is a normal tax year, what's a what's a special tax year, and what's a transitional tax year. We talked about these things. We talked about the heads of income, that the income from income is computed under these 5 heads, which could be the income from salary, income from other source, etc., etc. Then we move forward, and then we started discussing about the concept of total income. We talked about the concept of taxable income. We did discuss that how the taxable income is ascertained, and the deductions that are allowed while computing the taxable income, zakat, profit on debt, education expenses, etc., etc. We talked about all of them. The later on, we talked about the definition of the person, that what exactly is the definition of person. So we talked about that also. And later on, what we did was we moved on, and we started discussing about the concept of taxpayer, the residential status, and the taxability. And then later on, we moved on to the resident individual and non-resident individual, resident company, resident AOP. These were the basic concepts that we talked about. The next step was basically we started discussing about the income from salary. So we talked about the salary as something which is received by an employee from an employment. So we did discuss the definition of employee, employer, employment, everything. And then we move forward. We talked about the concept of the receipt of income, as I did discuss that the salary is taxed on a receipt basis. So what exactly do you mean by a receipt of income? So we did talk about that specific concept, that what exactly do you mean by the receipt of income. Later on, I move forward. I discuss that how is the salary taxed on a due basis, how is the salary taxed on how is the salary which is received in arrears is taxed. Then I talked about what constitutes salary. So basically, what we did discuss was we had discussed about remuneration, we had discussed about allowances, and we had discussed about the perquisites. Um, And then later on, what we did was we discussed amounts in addition to salary. This is what we discussed in the yesterday's session. So now what I'm actually going to do is that I'm going to move forward, and I'm going to discuss further with respect to the salary. So up till now, this is what we have discussed with respect to the salary. The last thing that we did in the yesterday's session was the concept of termination benefits. So is everyone okay with what we had in the yesterday's session? And if there is anything else that you would want me to cover up, or that you would want me to tell, so do let me know, and I can actually cover up those things also. Please do let me know that if there are any issues with respect to what we have discussed in the yesterday's session, so I can have a quick recall. Otherwise, I'm gonna move forward. Okay, let's move forward. Now, the next thing that we are going to discuss with respect to the salary is the concept of post-employment benefit. Now, what exactly is the post-employment benefit? So when we talk about the post-employment benefit, so basically what happens is the companies, they have got various schemes of rewarding their employees, and the various types of post-employment benefits that do exist include the pension, gratuity, provident funds, annuities, etc., etc. Now, what exactly is the pension and how do we pay the pension to the employees? So the pension which is paid to the employees is paid in this specific manner. That generally what happens is there is a formula devised by every company, and what happens is that the company, it pays an X amount to the employee from the date of retirement. From the retirement date till, what happens is from the retirement date till the death, he gets an X amount. Once he dies, what happens is his spouse, they start getting till their death. A 50% amount is given to the spouse till the death. So now, if I talk about the post-employment benefits, every company has got different types of benefits. So one of the examples is of the pension. The other example is of the gratuity. Usually the gratuity is paid like this, which is the final salary multiplied by the number of years of service. Number of years of service and multiply by whatsoever, like it could be 80%, it could be 90%, etc., etc. So that is what the salary is. Abdul Samad, yesterday's slides will be shared to you via email today, and also the lectures have been uploaded on the ACCA's channel on Vimeo. The third thing is basically called Provident Fund. What exactly is the Provident Fund? When we talk about the Provident Fund, so basically Provident Fund is like this, that when we talk about the Provident Fund, so Provident Fund is basically a scheme where what happens is a certain amount is deducted from the employee's salary. So there is a certain amount which is deducted from the salary of the employee, and an equal amount is contributed by employer. Equal amount is contributed by employer. That's what happens. So a certain amount is deducted from the salary of the employee, and an equal amount is deducted, is actually an equal amount is contributed by the employer. Now what next is there? What next is there is basically this amount is put into a separate fund. So generally speaking, the contribution which the employer is giving from his side, that is actually something that is a benefit given to the employee during the course of his employment. That's called the Provident Fund. Now, what next is there? When we move a bit forward, so let's actually discuss about the concepts of the provisions of the pension. So if I talk about how the taxability of the pension is there, so because we are computing the income from salary, and for us to compute the income from salary, we need to have the provision of how the pension is estimated. So now it says the pension received by a citizen of Pakistan from the former employee shall be exempt from tax, except where person continues to work for the same employer and an associate of the employer. Like for example, you were working for let's say um, Angro Fertilizer, and you retired from Angro Fertilizer. Now you have actually started working for Angro Thar Coal Mining Company. Angro Thar Coal Mining Company. So if you started working for Angro Thar Coal Mining Company, then what is actually going to happen is, resultingly, what is actually going to happen is that you are now working with the associate of the same employer. So if you are now working with the associate of the same employer, so what happens is your pension from Angro is not going to be exempt. But if you don't work for any associate, then your pension is going to be exempt. Number two, it says where you receive more than one pension. Like for example, you are working, you retired from one company, then you went on to another company, you retired from there also, you went on to the third company. So like for example, if you keep on retiring, then what happens is, if you receive more than one pension, then what happens is the higher of the pension is going to be exempt. So like for example, you're receiving one pension which is 20,000 a month. You're receiving another pension which is 28,000 a month. So what is actually going to happen? What is actually going to happen is that this 28,000 is going to be exempted from tax, and the remaining amount of 20,000 is going to be taxable. Similarly, it says that if you have worked for federal government or the provincial government or armed forces, then your pension is exempt from tax. Lastly, the pension over 60 years. If you are in 60 years, if you are somebody who is more than 60 years of age, all the pensions are exempt irrespective of the above mentioned condition. That means if you retire, if you are at the age of 60 plus, then what happens is that if you are basically of the age of more than 60 years, even if you receive three pensions, all of them are going to be considered as exempt. So basically what happens is when we talk about the concept of pension, so this is how the taxability of the pension arises. How the taxability of the pension arises this way, that if you are receiving only one pension, that's exempt. If you are receiving more than one pension, then the higher amount is exempt. If you are receiving pension from federal government, local government, provincial government, armed forces, then that is exempt. And if you are of the age of 60 years or more, then all of the pension that you are receiving is going to be exempt. The next situation, which is the post-employment benefit, the next aspect is the gratuity. Now, what exactly do we mean by gratuity? There are actually various types of gratuity funds. One of the gratuity funds is like it pertains to the government employees. So like for example, if there is a fund which is established by government or any of the government institution, then what happens is whatever payments that are made to employees out of that fund is the exempt income for the employee. So if you receive salary from a gratuity, which is government approved gratuity, then that's going to be exempt. Second thing, if you have gratuity fund which is approved by Commissioner Inland Revenue, then that is also fully exempt. Now, what exactly do you mean by this? Let's try to understand. Basically, what happens is um, an employer, when he hires you and when he gives you gratuity, so generally what happens is he creates a gratuity fund also. When he gives you gratuity, he creates a gratuity fund also. Now, what is that gratuity fund? The gratuity fund is basically a separate legal entity that is established where the gratuity payments are accumulated together, and those payments are then going to be used to make payments to the employees. So there is a provision in the income tax ordinance which requires you to get your funds approved from the Commissioner Inland Revenue. If you can get the approval of your fund, then whatever payments that you make to your employees out of that approved fund, all of them are going to be exempt. But similarly, if your gratuity fund is unapproved, then what happens is the amount that is exempt is only up to 75,000 or 50% of amount payable, whichever is lower. So the exemption is going to be 50% of the amount payable or 75,000, whichever is lower. Now what next is there? So basically that is the second aspect and the third aspect. And the fourth aspect is there are few schemes which are approved by the board. Now, there are few companies, there are few organizations which get their schemes approved by the Federal Board of Revenue. So if there is a scheme which is approved by the Federal Board of Revenue, then what happens is that the exemption limit is only up to 300,000. Now, from the exam perspective, you need to remember all this, that if there is a government employee or if there is an approved gratuity fund, that's exempt. But if there is a gratuity fund which is unapproved, then the exemption is the lower of. Exemption is the lower of 50% of the amount payable or 75,000. And lastly, if the scheme is approved by the board, then 300,000 is the exemption limit. Now, there are a few things which you need to understand. The law says exemption in respect of unapproved gratuity shall not apply. So this limit, the unapproved gratuity shall not apply if payment not received in Pakistan, or if payment is received by a director of a company, any payment received by non-resident, or the gratuity received by an employee who has already received any gratuity from the same or other employer. So basically these are the four conditions. Any of these conditions, if it prevails, then what happens is that the gratuity that you receive from the unapproved fund, no exemption applies to that, and the entire gratuity is taxable. Okay, the next aspect of this is basically about the Provident Fund. The next aspect is basically about the Provident Fund. So if I talk about how the Provident Fund is accounted for, let's actually discuss. You see, there are basically three types of Provident Fund. One is government, the other one of them is recognized, and the third one of them is unrecognized. Now, when we talk about the Provident Fund, so let's try to understand something. Basically, what happens is, try to understand how the Provident Fund operates. Let's try to understand how the Provident Fund operates. If I talk about how the Provident Fund operates, let's try to understand. Basically, what happens is, this is employee, this is company or the employer. What happens is, a certain amount is deducted from his salary. There's a certain amount deducted from salary. The equal amount is contributed by the employer, and this fund, this amount is contributed into a separate legal entity called the Provident Fund. Now, for example, 100,000 has been deducted from the employee's salary in the year, and 100,000 would have been paid by the company. So the Provident Fund now has 200,000. So what happens is, this Provident Fund, what it does is, it invests this money. It invests this money. Where does it invest this money? It invests this money into the Provident Fund. What it does is that it invests this money XYZ. It may actually be depositing it into a bank. It may actually be depositing it into some certificates, etc., etc. So that's what the Provident Fund does. Now what next? So basically what happens next is that the interest income or the return is earned upon it. So if the employee, he withdraws the money, so he gets three things: his own contribution, he gets employer contribution, and the third thing that he gets is basically the interest. So the employer, what he does is that he gets these three things: own contribution, the employer contribution, and the interest income. Now, what the tax authorities, they have done is, they have prescribed the limits of exemption with respect to all this. They have prescribed the limits of exemption with respect to all this. Now, what is it? It says when the employee gives contribution into the fund, there is no treatment in either of the funds. Number two, if the employer gives contribution into the fund, that income is exempt, no treatment in unrecognized fund. Then it says limit on employer's contribution is rupees 150,000 or 1/10 of basic plus dearness allowance, whichever is lower. Now what exactly do you mean by this? What's a dearness allowance? It is more usually called in the short form as DA. Now what is this dearness allowance actually? What exactly is this dearness allowance? When we talk about this dearness allowance, the concept of dearness allowance is that usually in the companies what happens is, this is something which is given in addition to the salary, that there are few people whom you want to give additional benefit, but you are not able to upgrade their ranks or anything. So you give them a dearness allowance. You give them what? Dearness allowance. So that is what is considered to be a dearness allowance. Now let's try to understand. So basically what happens is that if, for example, you are an employer, you have paid 150,000 into the fund on behalf of your employee, or 1/10 of the basic salary plus DA, whichever is lower, that is exempt. So if you paid 230,000 and the exemption limit is, let's say, 150,000, so the balance 80,000 is going to be added to the employee's taxable income. So the balance amount is going to be added to the employee's taxable income. So basically, employee's contribution, no treatment. Employer contribution, there is a treatment with respect to the limit. If you pay amount in excess of the limit, then you have to add that amount to the employee's salary. Then what about the interest treatment? So it says yearly interest is exempt at the higher of 16% of interest on accumulated balance, or 1/3 of basic plus DA. And lastly, when an employee withdraws the fund, so basically what happens is it says only employer's contribution and interest is taxable in the year of receipt. So basically it depends upon what sort of fund is there. If the fund is an approved or a recognized provident fund, then these are the limits that you have to follow. If the fund is not recognized, if it's an unrecognized fund, then this is what you have to follow, that at the time of withdrawal, what happens is the contribution that the employer has paid and the interest on the accumulated balance, these are going to be taxable in the year of receipt. So is everyone okay with this post-employment benefit treatment with respect to the income from salary? So we have discussed how pension is treated, we have discussed how gratuity is treated, and also how provident funds are treated. Everyone okay, so that I can move forward? Okay, let's move forward. So we are done with this specific aspect also. The next concept is called the concept of tax on tax. Now what exactly do you mean by tax on tax? So let's try to understand this. What is this tax on tax all about? If I talk about the concept of tax on tax, okay, Jawadur Rahman has a question and Muhammad Amin also has a question. Muhammad Amin is asking a question. Kindly explain with example of interest exemption. Okay. So I'm gonna answer the question of Muhammad Amin first, then I'm going to move forward. Let's try to understand this. For example, the salary is the basic salary is 1 million. The dearness allowance is, let's say, 200,000. So in total this is 1.2 million. Now what happens is the exemption which is given is basically 16% of interest on accumulated balance, or 1/3 of basic plus DA. So if I talk about 1/3 of it, so that makes it 400,000. Assume that the accumulated balance, of the Provident Fund is, let's say, 8 million. So if there is 8 million multiplied by 16%, how much does it turn out to be? How much does it turn out to be? Okay. So it turns out to be 1.26 million, right? 1.26 million. So if there is an accumulated balance of 8 million multiplied by 16%, 1.26 million, then what happens is the exemption is basically, there is an error with respect to what it is mentioned over here. The yearly interest is exempt up to the higher of. It's not higher of, it's actually lower of. So basically this 400,000 is exempt. So 400,000 is exempt and the balance is taxable. Is it okay now, Muhammad Amin? Okay. Jawad Rahman is asking a question, and his question is that where his question is that will there be taxes be levied upon individual receiving the provident fund or the fund itself? Well, it's gonna be upon the individual, because what would happen is that you are being given the benefit, and this benefit is being given because you are working for a company. So basically, what would happen is that it would be added to your income from salary. Okay, let's move forward now. The next aspect is basically called tax on tax. Now, what exactly do you mean by tax on tax? Usually what happens is you give your employees a favor. Now what favor do you give to your employee? You give your employee a favor that you come to us, you work with us, no matter whatever the tax implications are, we are going to bear those tax implications, and we'll make sure that the entire tax is paid by the company and that you don't have to bear a single penny with respect to the tax. So in case if the employee is getting such a favor, if the employee is getting such a privilege, if the employee is getting such a benefit, then what happens is such benefit is also taxable. So when we talk about the concept of tax on tax, the tax on tax actually means that the employee's tax liability is settled by the employer. And as a result of this, since the employer is giving you a benefit, so what happens is that uh, it's included in your taxable income. It's actually included in your taxable income. So it says where employer agrees to pay the tax chargeable on an employee's salary. The amount of employee's income chargeable under the head shall be grossed up by the amount of tax payable by employer. So whatever tax that's going to be payable by employer is going to be grossed up. There is an example for the illustration. You people can see this example and can get a better understanding of this. See, this is a salary taxable income, 1.55 million. There's a tax on this salary of 99,500. The example is based on the previous tax rates. It's not based on the current tax rates. The example is actually based on old tax rates. So you see this. What happens is 1.55 million is the gross income on which the tax of 99,500 is payable. Now what the employer does is that he pays this tax. Once he pays this tax, once he pays this tax, the tax is actually paid by the employer. Once he pays this tax, then what actually happens is this amount is added to this amount and it becomes part and parcel of the salary. So the revised salary income becomes this. Now what happens is the revised tax liability is established, which is 114,425. If the revised tax liability is 114,425, then the difference between these two is 14,925. The employer pays this amount again. It's actually tax on tax. It's actually tax on tax. Because you see what happened is you had a salary of 1.55 million, the tax was 99,500. Employer paid this. Once the employer paid this, it now has to become part of the salary. And the revised salary's tax now becomes this. So the employer has committed to the employee that he's going to end up paying the entire tax. So what happens is 99,500 has already been paid. The difference between these two is paid to the employer now. What next is there? this amount is added to this amount, which is 14,925. The additional amount is added to this income, so you get this. Then you establish a tax liability again on this. The difference between these two is paid in here. So basically what happens is we continue this exercise till the time this additional amount becomes a zero. Till the time this additional amount becomes zero. So but generally what happens is, in this example, the original salary was 1.55 million, but this additional, the cumulative tax paid of 116,000 is now going to be added to the salary. Resultingly, this is where you are going to stand. Is it okay now? So what exactly is the concept of tax on tax? The tax on tax actually means where the employer pays the tax on behalf of the employee. Then we say that it's tax on tax. Okay, anyone has any questions here? If you have any questions, please do ask. Okay, Jawad Rahman, you are saying that you did not understand 116,000. Do you understand this 114,425? Okay, so I think students are having issues here. So I'm going to repeat it again. Now, first of all, let's try to understand the concept of tax on tax. What exactly do you mean by tax on tax? Tax on tax is basically where the employer commits to his employee that your tax liability is going to be settled by the company. Now, so if the employer commits that the tax liability is going to be settled by them, then this benefit which the employer gives to the employee, this is going to be included in the income from salary of the employee. Now let's try to understand this. We are taking this example where an employee had a salary of 1.55 million. We computed the tax on this. It turned out to be 99,500. The employer paid this tax to the government. Now what happened is, once the employer paid this tax to the government, so this tax becomes a benefit paid to the employee. Now when it's a benefit paid to the employee, it has to be included in his salary. Why? Because his salary is now no more 1.55. It has now become 1.55 plus 99,500. So this is what the salary is going to be, 1.649 million. Now, so if his salary is now this, so what is the amount of tax that he is required to pay on this salary? So we have calculated, we have taken an assumption based on the tax rate, which are old tax rates. 114,000 is the total tax liability. Now, the problem is that out of this 114,000, 99,500 has already been settled to the government. So the additional amount of tax that needs to be paid is 14,925. If the additional amount of tax is 14,925, then what happens is the the employee's salary, which was 1,649,500, would now have an addition of 14,925. So if there is an addition of 14,925, then this total becomes 1,664,425. If this total becomes 1,664,425, so there is a revised tax computation on this, which is 116,000. 114,000 has already been paid. So now the difference of 2239 is paid in the next session. And then it is going to be added to the salary again. The revised computation would be done, and it will keep on going and going till the time this figure becomes zero. Do you understand now? Okay, so perfect now. So basically we are done with this concept of tax on tax. Now let's move forward and let's start discussing about another concept which is called the employee share scheme. I'm going to give a brief introduction about the employee share scheme, that what exactly is this employee share scheme. A lot of companies, what they want to do is that they want to reward their employee, and in order to reward their employee, they either give shares to those employee or they give share options to those employee. So I'm repeating it again. A lot of companies, what they want to do is that they want to reward their employee for the services that they have delivered, and either they give the shares to the employees or they give the share options to the employee. So now the shares, if they are given, even the shares, even if they are given for a cost, the shares, even if they are given for a cost, usually what happens is the market value is high and the price charged to the employee is low. So for example, if the market value of the share is 25 and the employee is being given share at 10 rupees, so that means the 15 rupee benefit is given to the employee. That means 15 rupee benefit is given to the employee. So this 15 rupees has to be included in the salary. That's number one thing. Number two, at times what happens is you give your employees share options. The share options gives them a right to buy the shares. The share options also have a worth, they also have a value. So for example, if you're given your employee share options, then what happens is those share options also have a worth. For example, if the share option is worth 4 rupees and you've given your employee 100,000 share options, so that means 400,000 is the amount that needs to be included in the salary. Now, the concept that we need to understand is that what amount is to be included in the salary income and at what time do we need to include that amount into the salary income. So the concept that we need to understand is the amount to be included in the salary income and what amount is going to be included in the salary income. That is what we need to understand. Now let's try to understand this. So basically what happens is the types of shares that we actually, the type of shares that we actually give. The first thing is it says the option shall not be chargeable to tax, but if the option is exercised, then that's a benefit paid to the employee. That's number one. Number two, if you give your employees shares, then the shares are of two types. One of them is unrestricted, the other one of them is restricted. Now, what exactly do you mean by unrestricted shares? Unrestricted shares actually mean that there is no restriction in selling them. The unrestricted means there is no restriction in selling them. Now, let's try to understand. If there is no restriction in selling them, then how much amount is to be included in the salary? So the law says include amount in the year the option is exercised. Include amount in the year the option is exercised. The year in which option is exercised and the shares are acquired. So the amount to be included is basically what? The amount to be included is fair market value of the shares on the date of the issue less consideration for shares and share options. So what is the amount that needs to be included is the fair market value of the shares on the date of the issue less the consideration for shares or the share options. So like for example, if you have paid, if the market value of the shares on the date of issue was 20 and you have paid 3 rupees, that means 17 is going to be included in your taxable income. Similarly, the second aspect is basically the restricted shares, and the restriction is with respect to selling these shares. So if the restriction is with respect to selling these shares, how do we account for the shares with restrictions? Let's try to understand that concept. So basically what happens is the amount to be included in salary The amount to be included in the salary is basically um, upon the earlier of the time the employee has a free right to transfer the shares or the time employee disposes of the shares. Now I'm going to explain to you these things. For example, I've got shares and I've got a share of a public company and the company is unlisted. The company has placed restriction on the transfer of shares. The transfer of shares is restricted right now. I cannot transfer the shares into anybody's name. I've got one of my friend whom what I do is that I sell those shares to him. And I tell him that, look, I cannot get them transferred into your name right now, but I'll do them at a later stage. I'm telling him, say, I cannot transfer these shares into your name right now, but I'll do them at a later stage. Now let's try to understand. Although I don't have the free right to transfer the shares, but I've actually disposed of the share. I've actually disposed of the share. So basically what happens is the amount chargeable to tax shall be upon the earlier of. Shall be upon the earlier of. The time the employee has free right to transfer the shares. The time the employee has a free right to transfer the shares or the time the employee disposes of the shares. The time the employee disposes of the shares, whichever is earlier. Now, how much amount is to be included? So basically, the amount to be included is calculated in the same way. The only difference is the fair market value is the value of the earlier of date when restriction expires or the disposal. So that's what it is. Otherwise, this is almost the same concept with respect to unrestricted shares, except that the date, the fair market value, the date on which the fair market value is going to be used is going to be the date when the restriction expires, is going to be the date when the employee disposes of the shares. So that's what it is going to be. Is it clear to everybody? That's also another type of benefit that the employee receives from his employment. Yeah, anyone has any questions in relation to this, please do ask before I can move on to the next area. So please do ask before I move on to the next portion. If you have a question, those who are new to this meeting, what you could do is that you could write down your question into the chat window in your GoToWebinar section. Okay, we have Mustafa Bilal. He's asking that I did not understand the concept of restricted shares. Mustafa, the concept of restricted shares is that you issue the shares to the employee and you don't place any restriction upon them with respect to. You don't place any restriction restricted shares is that you place a restriction upon them that they cannot sell this share to anyone. They cannot sell these shares to anyone up till a certain period of time. That's called a restricted shares. Or even if they can sell, they cannot transfer the shares into somebody else's name. Okay, is it okay now? Okay, so that marks the conclusion of the concept of employee share scheme with respect to the income from salary. We are now going to move forward, and the next situation is going to be the specific exemptions. Now, what exactly do you mean by specific exemptions? So, what happens is there are specific exemptions with respect to the salary that need to be considered and that need to be discussed. Now, let's try to understand the first thing is the benefits by virtue of employment. Now, let's discuss about each one of them. Before we discuss, I'm going to give you a just brief overview and an idea. Number one point is that when you work for a company, a lot of companies, what they do is they give you free education for your child, they give you free hospital facilities, they give you free mess facilities at the company. So there are a lot of things that the company they provide during the course of employment. So the law, it specifically exempts the following benefits that they are not going to be included in your salary. What exactly are they? It's a free or subsidized food provided by hotels and restaurants to its employees during duty hours. Free or subsidized education provided by an educational institution to the children of its employees. Free or subsidized medical treatment provided by hospital or clinic to employees and other perquisite for which the employer does not have to bear any marginal cost as notified by the board. Like for example, if somebody is working with PIA, then what happens is PIA is giving you free tickets. So the PIA might not have to bear any marginal cost. The plane is going, they're not flying the plane for you. They're not flying the plane for you. The plane is already flying. It's just that they're accommodating you. They're giving you one seat. So that is just fine for them. The other exemption is basically with respect to the medical allowance. I'm going to discuss about this medical allowance, that what exactly is the exemption of the medical allowance. Now let's try to understand. Basically what happens is the medical support or the medical facilities given by the employer to employee are usually in two manners. One of them is either the employer gives employee. They're actually in two manners. One of them is either the employer gives employee allowance or he gives him the facility. Now, for example, if the facility is given and it was already agreed, then such facility is going to be exempt. If the facility is given and it was not agreed originally, then it's going to be taxable. Like for example, a lot of companies they do is that they've got hospitals, they have doctors, they have got clinics on panel. Like anything goes wrong, you have to go there and you just have to get treated, and the payment is going to be made by the company. Now let's try to understand. If such a hospitalization policy is already agreed, if such a hospitalization policy is already agreed, if it is already agreed with respect to the at the time of employment, then it is going to be exempt. But it was not agreed and it was given to you in addition or just like that, then it is going to be taxable. If it was not agreed and it is just given to you just like that, then it is going to be taxable. The next situation is medical allowance. Now let's try to understand. The medical allowance is usually given in cash and it is exempt up to 10% of basic salary. So when the companies they create the salary structure, they create like this. Some portion is basic salary, some dearness allowance, some conveyance allowance, etc., etc. The salary structure is created like this. So what happens is if the salary structure is created like this, then what actually happens is that the 10% of the basic salary is computed and the medical allowance up to 10% of the basic salary is exempt. Like for example, if the medical allowance given to the employee is 40,000 and 10% of the basic salary amounts to 36,000, then 4,000 rupee is basically included in the taxable income. It's taxable. So 36,000 is going to be exempt and the remaining is going to be taxable. So now what happens is, for example, if an employer is giving an employee both, which is allowance also and facility also, then what happens is facility is going to be exempt, but the allowance is going to be taxable. The allowance is going to be taxable and the facility is going to be exempt. So I repeated, what exactly is the exemption with respect to medical? If you get both, if you get allowance, if you get facility both, the facility is agreed and the allowance is also given, then facility is exempt, allowance is taxable. That's number one. If you give facility only and that is agreed, so that is also exempt. If you give facility and that was not agreed, then that's not exempt, that's taxable. If you give allowance only, then the allowance is exempt up to 10% of the basic salary. Allowance is exempt up to 10% of basic salary. So the only thing agreed with the employee at the time of appointing him within the employment or later on, that's what it is. Well, allowance, no, it's not necessary. What happens is, for example, you are working with me as an employee. I'm giving you an allowance, medical allowance in your salary. Now what happens is, somehow you fall sick and you have to ultimately spend a lot of money on your medical. Now what happens is, there was no agreement between us as an employer and the employee that I'm going to pay anything to you. But in a I mean, as a goodwill gesture, what I did was I paid you extra amount. So if I paid you extra amount, then what happens is that was not agreed. So the medical allowance is going to be exempt up to 10%, but that extra amount which I am being given with the facility that was provided, that is not going to be exempt, that's going to be taxable. So basically, the agreement is with the employee upon appointment or at a later stage, but the agreement is with the employee. Okay, is this clear to everybody? Okay, perfect. So that is an exemption that we have discussed. Now let's move a bit forward and let's try to understand the last concept with respect to it. So the last concept with respect to it is basically the exemption, which is about the seafarer. So what do we mean by seafarer? Now seafarers are those who work on ships, those who like master the ship captains and the chief engineers and etc etc. That is what the concept of seafarer is. Now let's try to understand this. If I talk about the seafarer, so it says a Pakistani seafarer working on Pakistani flag vessel. Now very important concept. A lot of people, they don't understand what's a Pakistani flag vessel. Just like you have got a car which is registered in Lahore, Islamabad, Karachi, so you have a specific number plate of that car. Similarly, a ship is registered in a country. So when it is registered in a country, the ship becomes resident for that country, and the income earned on that specific ship is being treated accordingly depending upon where is it registered, what flag it is carrying. So a Pakistani seafarer, you have to be Pakistani national, working on a Pakistani flag for 183 days or more during a tax year, or a Pakistani seafarer working on a foreign vessel, provided that such income is remitted to Pakistan not later than 2 months of the relevant tax year through normal banking channel. So if you are a seafarer working on a Pakistani flag vessel, your income from salary is exempt. If you are a seafarer working on a foreign flag, but you remit the entire amount of the salary to Pakistan, then your salary is exempt. So that's an exemption for the seafarers. Lastly, Pakistan source salary of resident individual. So if you are a resident in Pakistan, then your foreign source salary is going to be exempt provided you have paid tax in the foreign country on that. So basically that marks the conclusion of income from salary. I hope that everybody is okay with this. Okay, so that marks the conclusion of income from salary. But before we are going to move forward, I am going to attempt one of the question pertaining to this income from salary so that we can have a good practice with relation to it. Okay, this is actually a question which is basically a practice question which I would want you people to attempt. For all of you who are asking that where exactly that we can find this question. So in your go to webinar window, there is a handout section. There you can find a salaried case comprehensive. Salaried case comprehensive, that's the name of the question. So I'm giving you time till 9:10 p.m. to attempt this question. You need to compute the income from salary, and also okay, there's a student asking which book will you recommend for PK and variant? Well, there are few publications which you could refer to. One of them is writer Khalid Petiwala. You can refer to Khalid Petiwala's books, or alternatively, you could refer to the books pertaining to the local body, local chart accountancy bodies. Um, Anyways, now let's try to attempt this question and then we'll discuss at 9:10 p.m. You've got 9 minutes to attempt the question. Okay, now let's start discussing about this question. So basically what we are going to do is that we are going to start computing the income from salary. The requirement of this specific question was compute the taxable income and tax liability of Mr. Abdullah for tax year 2015. It's a bit old question, but we'll do it accordingly. It says Abdullah has been working as a full-time teacher in an institution recognized by Higher Education Commission. His monthly salary included a basic salary of 250,000 and dearness allowance of 30,000. So basically what happens is his basic salary is 250,000. There is a dearness allowance that he is being paid, and that is 30,000. In addition, he was also entitled to a medical allowance of rupees 29,500. So he is also being entitled to a medical allowance of 29,500. So if I sum up these, then what happens is you have got 250,000 plus 30,000 plus 29,500. This actually gives you 309,500. This gives you 309,500. That's a monthly remuneration. He says during the year, Abdullah also had foreign source income from one of his business ventures of 750,000, on which a tax of 48,000 was paid. So I would tell you to ignore this right now. But if I talk about it, then what happens is the exemption pertaining to basic salary with respect to the medical allowance, that exemption is going to be what? It was 25,000 multiplied by 10%. So 25,000 is basically exempt. So resultingly what happens is, if we talk about it, 284,500 is a monthly taxable income. You multiply it with 12 months. So you get 3,414,000. That's your income including basic, dearness allowance, and the taxable medical allowance. It says in addition to the salary, he had the following additional benefits available. A car for his personal and official use, having cost 1.2 million to the employer. So what happens is when you go for this car is a perquisite. So the conveyance, which is the car, is worth 1.2 million, and 5% of the car's value is going to be added to the taxable income. So this actually gives you 60,000. This actually gives you 60,000. He says a reimbursement of personal medical of expenses of 250 on account of hospitalization charges of his daughter were made after procuring hospital bills showing the national tax number of the hospital. Now let's try to understand this thing. We are not being mentioned in the question that whether this was in accordance with the terms of the employment, or was it without not agreed, or was it not in accordance with the terms of employment. So I am taking an assumption, which is that it was not in accordance with terms. It was not in accordance with terms. That is the assumption that I am taking. Now what next is there? It says rent-free accommodation having monthly rental of 20,000 or cash in lieu thereof. However, he has opted to take rent-free accommodation. So monthly rent-free accommodation. So what happens is when we talk about rent-free accommodation, so fair market rent is 240,000 in a year and 45% of basic or MTS. So 45% of basic is basically you have got a monthly basic salary of 250,000. You've got a monthly basic salary of 250,000. So it's going to be 250,000 multiplied by 45% multiplied by 12. So how much is going to be the amount? So this is 1.35 million. The amount to be included in the salary is the higher of these two. So this is going to be added to the salary. It says a special allowance of 150,000 to meet traveling, boarding and lodging expenses to be incurred by him. In the normal course of his employment duties during the year, he incurred expenses of 122,000 and kept a balance amount with him. I did tell you while discussing the income from salary that in case if you get any allowances for your trip for the business, and if there is any amount left over and you are being given that amount by the employer, then that such amount is also exempt from tax. So this is actually going to be exempt from tax. Next. In tax year 2014, Abdullah was prematurely terminated from employment and received a compensation for early termination of 5.5 million. His taxable income during the last 3 years was this. So this is actually a termination benefit which we are going to add up in the later stage after deciding that what to do. Now what next is there? He says the monthly salary of 14,000 was paid to Mr. Abdullah's housekeeper. Abdullah, however, reimbursed 20% of the housekeeper's salary to the company. So what happens is the housekeeper is also a perquisite that is being given to him. So 80% of the housekeeper's salary is going to be included in the salary, which is 80% into 14,000 into 12. So this gives you 134,400. Now what next is there? It says Provident Fund was deducted at 10% of his basic salary. Company contributed an amount equal to the fund. Since this was the first year of employment, the only balance accumulated in the fund was the contributions made during the year by entity and deductions from Abdullah's salary. During the year, Provident Fund account was credited with an interest of 678,000. Now let's talk about it. So when we talk about the Provident Fund, so it says 10% of the basic salary was deducted. So contribution by employer is going to be 250,000 into 10% into 12. Gives you 300,000. It actually gives you 300,000. Now what next is there? The exemption is basically lower of 150,000 or the exemption is the lower of 150,000 or 1/10 of the basic plus GS. So the lower amount is going to be 150,000. So the amount is to be included is 150,000. Then let's talk about the interest. The actual amount credited is 78,000. and the 16% of the accumulated balance. Now, what is the accumulated balance? It's the amount which is deducted by the employer and deducted from the salary of the employee. So 300,000 by employer, 300,000 by employee. So this actually gives you 96,000. So the amount to be included in the salary is going to be 96,000 minus 78,000, which is 18,000 is to be included in the salary. Now what next is there? So we've gone through the Provident Fund also. He says he obtained loan of 900,000 at a rate of 4.5%. So we know that whenever you get the interest-free loan or a lower rate loan, the interest on loan, that is going to be 5.5% multiplied by 900,000. Now where did we get this 5.5%? Because you know the benchmark rate. You know the benchmark rate is 10%, and you've got the loan at okay. There is a student asking that you did not compare one third. So I did not compare one third because I already knew that it's going to be quite high, so I did not compare it. He says on 1st August he inherited 25,000 shares of a private limited company. The estimated fair market value was so and so. Anyways, this falls under capital gain, so I'm gonna skip this right now. It further says under an employee share scheme, Abdullah was awarded 5,000 shares on 1st July 14. Under the scheme, he was not allowed to sell the shares up to 31st March 15. He sold all the shares on 1st May 15. Fair value of the shares on the above date was as follows. So 20 rupees was the share on 1st July 14. That's not relevant. 31st March 15 is a relevant date. So basically what happens is the shares that are to be included. So it's going to be 28 multiplied by 5,000. So the amount to be included in salary is 140,000. Now what next is there? So we have considered this adjustment also. I just need to see that if there is any other adjustment that I have skipped. So I have skipped this specific adjustment, and I've also skipped this specific adjustment of termination benefits. So these are the adjustments that I have skipped till now, and I'm going to consider them a bit later. He says the following information is also relevant. He paid zakat of 30,000 to an approved organization through a cross check. So you do know that the admissible deduction includes zakat of 30,000. And he says profit on debt. So the profit on debt on a house loan obtained from a scheduled bank. So if there is a house loan obtained from scheduled bank, so there is an amount which could be deducted, which is 50% of taxable income or the actual interest, or 2 million, whichever is lower. So if you go for it, the 250,000 is going to be the lower amount. You deduct all of them and you will end up getting the taxable income. So this is how it is actually going to be solved. Is everyone okay with this? Yeah, is everyone okay with this? Okay, when we talk about profit on debt, the profit on debt is basically you can claim if you have paid interest on house loan, then what actually happens is um, the the interest is deductible from the income from salary, and the deduction, sorry, not from salary, from the taxable income, and the amount of deduction is basically going to be the lower of actual interest paid, or 50% of your taxable income, or it is going to be 2 million rupees, whichever is lower. So if you would have done the calculation, you would have got only 250,000 to be a lower amount. Somebody is asking that rent-free accommodation. Okay, so the amount with respect to the rent-free accommodation to be included in salary is the higher of the fair market rent, or 45% of the basic salary plus the dearness of the basic salary. So whatever is the amount that needs to be included, the higher amount needs to be included in the salary. Okay, is everyone okay with this? Okay, so that marks the conclusion of the income from salary. We're gonna take a 15-minute break here, and once I come back from the break, the next thing that I'm actually going to be discussing will be, once we come back from the break, the next thing that I'll be discussing will actually be income from business. It's going to be income from business. So the next thing that we shall actually be discussing is the income from business. So let's have a 15-minute break, and we will start our session at 9:45 p.m. Okay, so welcome back. Let's actually move forward and let's move on to the next area. And the next area is basically the income from business. The next area is income from business. Now, when we talk about the concept of income from business, you have got the definition of the business, which is the business includes. Now, so when we talk about the concept of business, so the definition of the business is the business includes. I did mention to you people earlier in yesterday's session also that when we talk about the inclusive definition, so what exactly do you mean by this inclusive definition? The inclusive definition actually means that whatever the word is there in the dictionary, whatever the word meaning is there in the dictionary, that meaning is actually followed. And in addition to that meaning, additional things are actually also being followed. So when we talk about the concept of the word, when we talk about the concept business, so what exactly do you mean by business? So the business actually means, it says business includes any trade, commerce, any manufacture, profession, vocation, adventure or concern in the nature of trade, commerce, etc., etc., but does not include employment. Now, a very important point is the exception is there that the business does not include the employment. It does not include employment. Now, let's start discussing about it. So, what exactly do you mean by this? Basically, if you are self-employed, you're not doing business. If you are self-employed, in fact, if you say that you're working somewhere and you are actually you're working somewhere and you're drawing salary, so that does not mean that you are doing business. You're working as a salaried employee. Now, so whether you are operating as a trading business, whether you are operating as a manufacturing business, whether you are operating in a service business, all of that is going to be considered as the word business. So business means trade, commerce, etc., etc., etc. Now let's move a bit forward. And we need to now discuss that what is included in the income from business. We need to now discuss that what is included in income from business. Now, when we talk about the concept of income from business, so what is included in income from business? There are few things which is actually referred. Number one, it says profits and gains of any business carried on by person at any time in a year. So at any time of a year, if you carry out if you obtain any profits, any gains, all of them is considered to be income from business. Any income derived by any trade, professional, similar association from the sale of goods or provision of services to members. Like for example, ACCA. When ACCA derives fee from the students, that's income from business. When ACCA derives subscription fee from the members and from the students, that's income from business. When ACCA derives other fees, that is all income from business. Or you can have other similar institution like Pakistan Engineering Council, Pakistan Medical and Dental Association, Pakistan PMDC, Pakistan Medical Dental Corporation, etc., etc. All of them are actually considered as business. Any income from the hire or lease of tangible movable property. Like for example, if you are hiring out machines, you are hiring out vehicles, that is all going to be considered as hire or lease of tangible movable property. Now, one exception that needs to be understood over here is that if you are hiring out immovable property, if you are hiring out immovable property, that is not considered to be business. What is that going to be considered to? That is actually going to be considered to be the income from property, because what happens is the immovable property, which is land or building, when you rent them out, the rental income that you receive is actually considered to be income from property. The next thing is the fair market value of any benefit or perquisite, whether convertible into money or not, derived by a person in the course or by virtue of past, present, prospective business relationship. Let's actually discuss about this concept. A lot of basically what happens is, um, for example, you you have a trading, you work as a supplier, you work as a supplier for a company which deals in rice. And what that company does is that company sends you around 8 to 10 8 to 10 trucks of rice. Now if they send you 8 to 10 trucks of rice without any cost, that is actually going to be considered as income from business, because this is because of the business relationship between you and that company. So anything that you receive because of the past, present, or the prospective business relationship, that is also going to be considered as income from business. Further, it says management fee derived by a management company. So at times what happens is you have got mutual funds, you've got mudarbas. So the mutual funds, they charge you a management fee. So whatever the management fee earned by a mutual fund is, that is going to be considered as income from business. Now what next is there? It says profit on debt where the person's business is to derive such income. Profit on debt where the person's business is to derive such income. Now when we talk about it, that what exactly is this profit on debt when the person's business is to derive such income, let's try to understand. If you are a bank, let's talk about it. If you are a bank, so what happens is, being a bank, your main business is to derive the interest. Okay, so if we talk about the profit on debt where the person's business is to drive such income, like for example, we talk about a bank, we talk about a bank, we talk about any other financial institution. So if you talk about a bank or you talk about any other financial institution, the bank or any other financial institution, their main business is to earn interest. So if they are earning interest, that interest is going to be considered as income from business. If they are earning interest, their interest is going to be considered as income from business. What next is there? The lease rentals derived by a scheduled bank or investment bank or mudarba or leasing company. So at times what happens is there are leasing businesses which lease out assets, could be home, could actually be cars, whatsoever. That is all going to be considered as the income from business. Now when we talk about this profit on debt actually means interest. So like for example, if you are a company or normal trading company, and if you earn interest income, I'm repeating it again, if you are a normal trading company and you are earning interest, then if you are a normal trading company and you are earning interest, that interest is other income, that's not income from business. But if you are a bank and you are earning interest, that interest is actually income from business. That interest is actually income from business. Now what next is there? The lastly, any amount distributed by a mutual fund or a private equity and a venture capital fund out of its income from profit on debt to banking or non-banking finance company. So anyways, to sum up, basically what does the business mean? The business means the main thing that you are actually made up of. The main thing that you are actually made for, that is considered to be income from business. Okay, let's move forward. So that's the basic concept of income from business. Now let's try to understand something, that how do we actually compute the income from business. So basically what happens is, whenever you go to the tax authorities and you actually declare the income from business to the tax authorities, so what happens is, the tax authorities, what they do is that they first of all they ask you to bring in your accounting P&L. The first thing is they ask you to bring your accounting P&L. So what happens is you take your accounting profit and loss account to the tax authorities, and the tax authorities, what they do is that they they pick up the profit before tax in your accounting P&L, and there they make adjustment. Few things are added, few things are deducted. What are added? Inadmissible expenses. Like for example, the accounting depreciation is not allowed by the tax authority, so we add it back. Why? Because it's already deducted from this profit. The impairment loss is not allowed by the tax authority, so we add it back. Or at times what happens is there are few things which are taxable. For example, you have received loan in cash. So if you have received loan in cash, the tax authorities, what they do is that they charge a tax on this. So any loan which is received in cash, that's considered as an income. So that is actually added to your income. So I'm going to repeat it again. What happens is the profit before tax is the starting point. And once you start off with the profit before tax, what happens is you add back the inadmissible expenses, the expenses which are not allowed to be claimed, and any other items which are taxable, which you have not included in your income, that are also added. Okay, what next is there? The next situation is less admissible deductions. Now, what is admissible deductions or the exempt income? Like for example, if you calculate the depreciation in accordance with the tax rules. So basically the tax depreciation or the tax amortization, that is all going to be claimable expense. The tax depreciation, the tax amortization, that is all going to be claimable expense. Then you've got exempt income. So what exactly do you mean by the exempt income? Let's try to understand this. When we talk about the concept of exempt income, the exempt income actually means that there are few income on which no tax is payable. There are few income on which no tax is payable. So basically you need to deduct it from the income which is added in the profit before tax. So generally speaking, what happens is whenever we talk about the computation of income from business, this is how income from business is computed, which is you start off with the PBT and then you add up the inadmissible deductions and you deduct the admissible deductions. That's how you do it. Now what next? Once this is generally a concept, this is generally a pro forma that you follow when it comes to the computation of income from business. Now let's try to understand that what exactly are these inadmissible deductions, what are these admissible deductions. So let's start discussing about it. But that's a general pro forma that is actually going to be followed when you talk about income from business. Now I'm going to talk about few of the key principles with respect to the income from business. So let's talk about few of the key principles. Now what are these key principles? Let's start discussing. Number one point is it says the basic principle behind admissible deductions is that expenditure to be incurred wholly and exclusively for business. Means what happens is you are a sole proprietor. For example, you are a sole proprietor, and being a sole proprietor, what happens is you run a car. That car is used for your personal expenses, for personal use also. It is used for your business purposes also. Now, a total expenditure of 100,000 on the fuel of a car is incurred. What happens is you cannot claim 100% of this expense. Why? Because the car is partly used for business and the car is partly used for personal use. Now what to do? What next? So basically what you actually need to do is that you only need to deduct whatever amount pertains to the business use. Like for example, you would say that 40% usage was for the business. Okay, so you claim 40,000, that's it. If the 40% usage was for the business, so you claim 40,000. That's it. Okay, now what next is this? That's the number one thing. Number two. Number two is basically only real profits to be taxed. That is, the notional profits are not to be taxed. Now, what exactly do we mean by notional profits? Let's try to be understand. First of all, the real profits plus the real expenses to be considered. Like impairment is not a real expense, it's an assumed expense. It's not actually something going out of your pocket. Similarly, the remeasurement gain or the fair value gain, because what happens is you purchase a property for 10 million rupees. Now the worth of that property has become 40 million rupees. So you've got a 30 million gain, but that's a notional gain. That's not an actual gain. That's not a real profit. That's not the real profit. So what is going to happen is only if you dispose of the property and you get a gain, that gain is going to be added to your taxable income. But otherwise, the notional gain, which is a fair value remeasurement gain, that is not included in the income from business. Next, profits arising from trading revenue receipts are taxable. Capital receipts are not included in income from business. So it says the capital receipts are not included in income from business. Now let's just start discussing. When we talk about the capital receipts, so what exactly do you mean by the capital receipts? Let's try to understand. The word capital receipts means, for example, if you issue shares, the issuance of the shares would lead to the share capital. Now, the capital is being raised for the business. Will it be taxable? Will it be included in the salary? Will it be included in the income from business? The answer is no. Why? Because uh, it is actually a capital receipt. It's not a revenue receipt. It's not because of your trading. It's a capital receipt. It's not a revenue receipt. Now what next is there? Let's move a bit forward. So these are the few principles with respect to the income from business. That is, only those expenditure which are incurred for the purposes of the business can be claimed as number one. Only real profits are to be taxed. The notional profits cannot be taxed. And only trading receipts are taxable. What is the second thing is that the following are taxable even if no business is carried out during a year. Even if no business is carried out during the year. Now what exactly are they? Number one, the gain on sale of a depreciable asset. Now let's try to understand. You were running a business and what you did was you closed the business in 2018. You discontinued your operation in 2018. I'm repeating it again. You are running a business, you discontinued our operation back in 2018. But the business assets or the business plant was not sold. I'm repeating it again. You discontinued the business operations in 2018, but the plant was not sold. The plant was actually sold in 2020. Now, if the plant was actually sold in 2020, so although you were not conducting the business in 2020, but still that plant pertained to your business. And if you have got a gain on disposal, or even if you have got a loss on disposal, that is going to be taxable on such year in which you are going to sell it. Why? Because although you were not conducting the business, but this was still a business asset and it's going to be taxed accordingly. Next, recovery in cash or kind. Recovery in cash or kind against the deduction or loss allowed previously against business income. Like for example, you claimed a bad debt of 5 million rupees in a year. Now what happens is in the next year or in a year or two, around 2 million out of that 5 million is recovered. Now around 2 million out of those 5 million is recovered. Then what is actually going to happen? What is actually going to happen is that those 2 million are going to be taxed in the year in which they are received. Those 2 million are going to be taxed in the year in which they are received. Now, what next is there? The next situation is basically the recovery made out of the bad debts allowed in the preceding years. So if you have actually claimed a bad debt in the previous year, if you have claimed a bad debt in the previous year, and what happens is that if you have claimed bad debt in the previous year, and subsequently what happens is the amount is recovered. So what happens is whatever the amount that you have claimed as a bad debt, that is going to be taxed in the subsequent year. Okay, now what next is there? The next situation is trading liabilities or any portion thereof which is found not to be have been paid within the expiration of 3 years of the end of the tax year in which it was allowed. Now this is something which is very important. What happens is at times what happens is uh, you because what happens is I'm going to discuss this concept a bit later also, but let's try to understand this. As per the tax rules, you are allowed to follow either the accrual basis of accounting or the cash basis of accounting. I am repeating it again. As per the tax rules, you are allowed to follow either the cash basis of accounting or the accrual basis of accounting. You are allowed to follow them. Now, for example, you are following accrual basis of accounting. And what actually happens is, while following the accrual basis of accounting, you claim an expense in a tax year. You claim an expense in a tax year. Now, when you actually claim an expense in a tax year, when you claim an expense during a tax year, then what happens is, and you have not paid that amount in the next 3 years also. You claimed expense in the current year, but you did not make payment. You did not pay the amount in the next 3 years. So if you did not make payment in the next 3 years, then what the law says is that if you have not made payment within 3 years, then in the fourth year, that amount is going to be included in your salary. In the fourth year, that amount is going to be included in your salary. Fourth thing, in your income from business. The fourth is sum received after discontinuance of business. Sum received after discontinuance of business. Now, what exactly do you mean by sum received after discontinuance of business? Like you discontinued the business. You discontinued the business and there was something that was recovered after the end of the business. So that is also going to be taxable even if no business was carried on during the year. Like you cannot claim that I did not carry out any business, so why should I pay tax? No, if anything pertains to your business, whether it is pertaining to past business or the current business or the future business, that is all going to be considered as income from business. Next. So is everyone okay till here? So I've discussed the basic concepts and I've discussed key principles. I'm going to move forward, but before I move forward, I would appreciate if you could just confirm to me that is all okay to you people and that you don't have much of the problem in what we have discussed up till now. Yeah, is everyone okay? Okay, perfect. Now let's move forward and let's just start discussing further. So if I start discussing further, let's just start discussing. Now, let's talk about the concept of inadmissible deductions. That what exactly are these inadmissible deductions? Let's just start discussing about them. The first thing with respect to the inadmissible deductions is it says any cess is a French word for taxes, rate or tax paid or payable by the person in Pakistan or foreign country that is levied on profits or gains of the business. So basically what happens is any amount of tax paid on your income, any amount of tax paid on your income is not claimable expense. Any amount of tax payable on your income is not deductible expense. Number two, any amount of tax deducted at source under the Income Tax Ordinance 2001. For example, if there is any deduction from your, I'm repeating it again. For example, if there is any deduction of tax from your receipts or etc., you cannot claim that deduction as an expense. The income tax that has been deducted is actually adjusted against the tax liability and is not claimable as an expense. Okay, there is somebody who's asking a question. If an expense is booked in 2017, then in 2021 it will become taxable, right, sir? Okay, like 17, yes, then 18, 19, 20. So these are the 3 years that are going to pass, and in 2021, if you have not paid it till then it will become taxable. Okay, so we are done with these two aspects. The third one of them is called any expenditure incurred from which the person is required to deduct or collect tax under income tax ordinance, maximum limit for purchase to be 20%. Now, let's try to understand that what exactly is this concept. I'm going to explain to you this specific concept. Let's try and understand. Now, what actually happens is, if I talk about this specific concept, then there is something which is called the concept of withholding. Now, what is withholding tax? Withholding tax means while making a payment, you have to deduct certain tax. While making a payment, you have to deduct certain tax. That tax is called withholding tax. The tax which is withheld, it's called withholding tax. Now, so if we talk about the withholding tax, there are certain incomes there are certain payments on which it is prescribed that the tax needs to be withheld. There are certain payments on which it is prescribed that the tax needs to be withheld. Now let's try to understand. So if there are certain payments on which the tax needs to be withheld, so let's just start discussing about them. If you make a payment and you don't deduct tax, then what happens is such expense shall be disallowed. If you make a payment and you don't deduct tax, then what happens is such expense shall be disallowed. But if you have made the purchases in the entire year and you have not deducted a single penny of tax from the payments made for such purchases, then the law says that the deduction that will be, that will be disallowed will be 20%, up to 20%. Like for example, you purchase 1 million worth of goods. Only 200,000 of the goods will be disallowed. The rest of the expense will be allowed. So basically the maximum limit is this. Next is it says any contribution made by the person to a fund that is not a recognized provident fund, approved superannuation fund, or so on so on so. So basically we did discuss in the income from salary that the funds which is either gratuity fund or the provident fund or the pension fund, They could be approved, they could be unapproved. If a fund is unapproved and you are making payments into the fund as an employer, as a business, then what happens is you cannot claim a deduction of the expense. Although if you would have been making payment to a fund which is recognized, you can claim the deduction. Further, any fine, any contribution made by a person to Provident Fund or other fund established for benefits of employee of the person, unless the person has made effective arrangements to secure that tax is deducted from any payments made by the fund in respect of which recipient is chargeable. Now, let's try to understand. We did discuss in the income from salary that, let's say you are part of, for example, if you are part of a company, you are part of a company and the company is giving you a post-employment benefit, and the post-employment benefit fund is not recognized, then what happens is whatever the amount that you receive from that fund is taxable. Now, for example, the company has established the fund and the fund is not recognized. I'm repeating it again. For example, the company has established the fund and the fund is not recognized. If the fund is not recognized, then what is actually going to happen? If the fund is not recognized, then what is actually going to happen? What is actually going to happen is that if the fund is not recognized, then the payment made out of that fund to the employee, a tax should be imposed on that. So if you are an employer and being an employer, you have made contributions into such a fund, then such a contribution into the fund is not deductible expense. You cannot claim that as a deduction unless and until you have made an arrangement. Unless and until you have made an arrangement, and that arrangement is that whenever the payment is going to be made out of the fund to the employee, the tax is going to be deducted out of it. So I'm repeating it again. You as an employer, you as a business contribute to a fund which is unrecognized. So you cannot claim expense, but you can claim expense if you have made an arrangement to have the tax deducted from the payments made to the employee. So if the payments are going to be made to the employee out of those funds, then there is going to be deducted. Then the next thing is, it says any fine or penalty paid or payable by a person for violation of any tax, rules, law, or regulation. Now try to understand this. For example, if you have got a customer contract and you make some breach on that and you are being levied a penalty, that penalty is claimable expense. If you breach a customer contract or you breach a contract with, not with the government, with somebody else, then what happens is you can claim that expense. But in case if you have got any violation of law where you're being imposed fine, tax, etc., etc., then such payment is not deductible. So that's one of the aspect of the inadmissible deductions. Now let's move a bit forward. So it's a repetition here. Then any personal expenditures, that's not claimable. Any amount carried to a reserve fund. Now let's try to understand what exactly do you mean by any amount carried to a reserve fund. Let's try to understand. A lot of companies, what they do is that when they operate, they actually transfer some of the profits into a reserve fund. So if you are a company who has transferred some of the profits to a reserve fund, then as a company, I'm repeating it again, if you are a company who has transferred some of the funds into some of the profits into the reserve funds, then you cannot claim such transfer as a deduction, because it's just a transfer. It's just allocation of the reserves. It's just the allocation of the profits into another head of account. Next, any profit on debt, brokerage, commission, salary paid by an AOP to a member of the association. A very important point. We do know this same concept in the accounting also, that If the company pays anything to its partner, if the business pays anything to its partner like salary or anything, etc., that's not claimable expense. The same goes here also. Now, what is that? Like, for example, if you so basically what happens is if an AOP, which is an association of person, if it pays salary, brokerage, commissions, etc., etc., to any of the member of its AOP, then such is not deductible expense. Next, any salary paid or payable exceeding 15,000 rupees. Well, it's quite vague, but this is how it is. If you have any of the employee whose salary is 15,000, is more than 15,000 rupees, and if you pay the salary not through the banking channel, if you pay the salary not through the banking channel but instead in cash, then such salary is not going to be claimable. Okay, Mohammed Amin, you're asking that you missed point 3. Now, point 3 was basically any amount carried to a reserve fund. Basically, what happens is just like you have got various equity heads like retained earnings, share premium, etc., etc. Similarly, there are various type of reserves also. So, in case, for example, if you transfer, in case, for example, you transfer the amount into the reserve fund, then such is not claimable as an expense. Anyways, so I'm coming into it. If there is anything like, for example, you pay salary to an employee in cash. So salaries up to 15,000 rupees a month are allowed to be paid in cash. Any salary over and above is not allowed to be paid in cash. What next is there? It says, so like if you have to pay salary, pay through banking channel. Don't pay through cash. Any expenditure paid or payable of a capital nature, like for example, you purchase a machinery which has a life of more than 12 months. So if you've got a machinery which has got a life of more than 12 months, then the payments pertaining to that machine are not taxable, are not deductible expense. You can claim depreciation on it, but you cannot claim the payment as an expense. You can claim depreciation on it, but you cannot claim it as an expense. Now, a very important point. A lot of you people would have an idea with respect to the sales promotion incurred by the pharmaceutical companies. You would go to any clinic, you would go to any doctor, you would find that medical reps or the medical representatives, they're usually sitting in there. The medical representatives, when they get in touch with the doctors, what they do is that they introduce the various medicines which they have introduced. They give a demo of those medicines to the doctors, and they encourage the doctors to sell those medicines. And in return, the doctor gets a commission for meeting the target. The doctor gets a trip to international conferences or the family trips or etc., etc. So there are various benefits that they provide to the doctors. Now, the point is, if you are a pharmaceutical company and you are paying out the sales promotional expenses, etc., etc., then no matter whatever the amount of expense that you will pay, the maximum amount that you can claim is 10% of your sale. The maximum amount that you can claim is 10% of your sales. Then any expenditure for a transaction paid or payable under a single account head which in aggregate exceeds 50,000 made in cash. Like for example, when we talked about the salary, we discussed that salaries in excess of 15,000 paid in cash are not allowable. But if we talk about the other aspect, which is basically the other payments which are paid in cash. So if you pay any payment in cash which is exceeding 50,000 rupees, then such payment is not allowable as an expense. Though there are exceptions. And what exactly are the exceptions? The exceptions are here. The exceptions are here. Now, so what are the exceptions? Like for example, if you make payments in cash for any expenditures, then they are not going to be allowed unless and until any single expenditure, any single invoice does not exceed 10,000. That's number one. Or you pay utility bills in cash, you pay freight charges, which is transportation, you pay traveling costs, you pay postage, which is the postage cost, or you pay taxes, duties, fines, penalties, etc., or any other statutory obligation. So these are five elements. Now, number one. For example, I made payment to my supplier in cash of let's say 90,000, but none of the invoices was more than 10,000 rupees. Then my payment in cash is allowable expense. If I made payment to my supplier of 60,000 and that was a one single payment, that will not be allowed. And if you make payments of utility bills or fines or penalties or taxes or ticketing costs, transportation costs, etc., in cash, they're all claimable expense. So inadmissible deductions are very important. That what are those expenses? What are those things which you cannot claim as an expense? So this is a general list of inadmissible deductions that we have discussed. Is everyone okay till here? We are trying to establish the income from business. Okay, is everyone okay till here? Is everyone okay? Anyone has any questions, please? Okay, so let's move a bit forward and let's talk about the other things. So the next thing that we are going to talk about is the other deductions. So the next thing that we are going to talk about, that is about the other deductions. Now, let's talk. So what exactly are these other deductions? Let's try to understand, let's try to discuss. This is a long list of other deductions which can be claimed. So what are these other deductions that can be claimed? The scientific research and employee training facilities and entertainment and etc. etc. This is a long list which we are going to discuss one by one together. Okay, the first thing that I'm going to talk about is the scientific research expenditure. Now, what exactly is the scientific research expenditure? So you see a lot of companies when they actually conduct the business. So while conducting the business, what they do is a lot of companies while conducting the business, they have to actually perform some research to explore new products, to explore new processes, to basically have alternate solutions to the problems, etc. They do invest a lot into the scientific research expenditure. So they can have their own research institution or they can have the research performed at some third party research institution, so that could actually be performed. So what happens is it says a person shall be allowed a deduction in scientific research incurred in Pakistan. Incurred in Pakistan. It's a scientific research which is incurred in Pakistan in a tax year wholly and exclusively for the purpose of deriving income from business chargeable to tax. Now, important thing. So if you have a research which is performed outside Pakistan, let's say in USA or in UK or Canada or China or whatsoever, then that expense is not deductible. What is deductible is the research incurred in Pakistan, and that is also subject to certain restrictions. And those restrictions are basically that any contribution to a scientific research institution to undertake scientific research for purpose of business, the acquisition of any depreciable asset or immovable property or purpose of ascertaining existence, location, so and so scientific research institution means what happens is, for example, for example, if you if you acquire a machinery for the research, that is not claimable expense. Though the depreciation is claimable, but that expense is not claimable. You acquire immovable property and you say that we are going to construct this building, convert this building into a research lab. The depreciation can be claimable, but otherwise it's not a claimable expense. So any scientific research expenditure incurred in relation to the business, provided it is incurred in Pakistan, you can claim that as an expense. You can claim that as an expense. Now what next is there? The second aspect. Employee training facility. Let's try to understand this thing. It says a person shall be allowed a deduction for any expenditure excluding the capital expenditure incurred in a taxi in Pakistan in respect of any educational institution or hospital in Pakistan established for the benefit of persons, employee and their dependents. A lot of companies, what they have their own hospitals, they have their own schools and colleges where the employees are being given access. Now what happens is that whatever the amount that is spent on those educational institutions, on those hospitals, that is actually going to be considered as that is also going to be considered as exempt. Number two, any institute in Pakistan established for the training of industrial workers, recognized, aided or run by federal government. So if you have got, let's say, you pay an amount to an institution which is run or managed by an organization, by the government organization, then what happens is it is actually considered to be what, exempt. Now also the training of any person being a citizen of Pakistan in connection with the scheme approved by the board for the purposes of this section, so all of that is going to be considered as exempt. So I'm repeating it again. What happens is when we talk about the concept of exempt income, so the employee training facilities, it says that if you incur expenditure for the educational institutions or for the hospitals or etc. in Pakistan, that is all going to be exempt. Okay, is everyone okay with this? Bed debt, I'm skipping it for tomorrow because the bed debt needs to be explained. I'm going to explain this tax accounting concept. That what exactly is tax accounting. You see, you have got a choice. If you are an individual or an AOP, you have got a choice. You can either opt for your taxable income to be computed on a cash basis or accrual basis. But for example, in tax year 2018, you went for the cash basis, and in tax year 2019, you want to switch to accrual basis. That can be done, but in order for you to do that, you'll have to justify to the commissioner that why exactly do you want to do it. That can be done, but for that you have to justify to the commissioner that why exactly do you want to do it. So I'm repeating it again. So basically, as an individual and an AOP, you can either opt for an accrual basis or the cash basis of accounting. But if you change from one method to another method in a tax year, then you need to justify. You need to justify to the commissioner You need to seek the permission of the commissioner. If the commissioner gives you a permission, you can switch. If they does not give you a permission, if the commissioner does not give you a permission, then you cannot switch. Now what next is there? For the company, the accrual basis of accounting is mandatory. For the company, the accrual basis of accounting is mandatory. Now what exactly do you mean by this? Like as a company, you don't have a choice. You have to follow accrual basis. As a company, you don't have a choice. You have to follow accrual basis. And as we did discuss earlier also that if you have an expense, if you have a liability which was unpaid, and if you don't pay it for the next 3 years, then in the fourth year it will be added to your taxable income. So the tax accounting, it's either individual or AOP, it's either of cash or accrual basis, but for the company it has to be accrual basis. The next concept is depreciation. Again, I'm skipping the depreciation also because there are a lot of things with respect to the depreciation that needs to be understood. Initial allowance is also there. I'm going to discuss this concept of pre-commencement expenditure. Now, what exactly do you mean by pre-commencement expenditure? That is also allowable for the computation of income from business. Try to understand this pre-commencement expenditure. If I talk about the pre-commencement expenditure, then pre-commencement expenditure means the expenditure which is incurred before the commencement of the business, which is usually an expenditure incurred for setting up the business, for ensuring that the things become in order. That is actually termed as pre-commencement expenditure. So when we talk about pre-commencement expenditure, so what exactly do you mean by pre-commencement expenditure? Pre-commencement expenditure means any expenditure which is incurred before the commencement of the business. That's called pre-commencement expenditure. Now let's try to understand. Basically what happens is, um, in the accounting, what we do is that we just expense out such sort of expenditure. For the accounting, we just do the expensing out. But what the tax authorities they do is that they tell you that you have to claim the pre-commencement expenditure as 20% per year, starting from the tax year in which it is incurred. So pre-commencement expenditure is the expenditure incurred before the commencement of the business, just to make sure that the business commences and the business operates in a proper manner. That is called a pre-commencement expenditure. Is it okay to everybody? Well, the examples of the pre-commencement expenditure would be, like for example, hiring of the employees, giving ads in the newspaper, setting up of the machinery, running the trial productions. You have not commenced the business, you're just setting up the machinery, testing the machinery to be okay or not. You're doing some marketing activities, you are registering the company. All of them is considered to be pre-commencement expenditure. They are not claimable as an I mean, you cannot recognize them as an asset in the accounting. They are just to be expensed out. But for the tax purposes, you have to defer them and you have to actually spread them over the period of 5 years. Okay. So what we are going to do is that we're going to keep it till here today, and we are going to move further tomorrow inshallah. But before we leave, I would appreciate if you people could actually share your overall understanding of the session today, and if it's actually doing the purpose that you are attending this specific session for. If it is serving the purpose, what you actually wanted to serve, then good enough. Or if you want any amendments, if you want any changes to be made, just let me know. I know there are few more practice questions that need to be done, but that's going to take me one more day before I can switch on to the practice questions. Thank you, Bilal. Thank you, Anil. Okay, Mohammed Amin, you're asking for super annotation. Okay, super annotation. Well, for when it comes to the super annotation, there are various types of schemes. Like for example, when you talk about the annuitation, so annuity fund is like when you get a constant payment over a certain period of time, that's called annuity. Um, super annuitation is basically when you get a constant payment for a certain period of time, and then you end of the day you get a certain amount, which is usually a big amount, that is called super annuitation fund. Bilal, thank you very much. Anil, thank you. Anil, your suggestion of 3 hours, um, shortening it so you can, once you are going to end the meeting, there's going to be a feedback that you can actually fill up. So you can give your feedback, overall feedback, that how the session was and what exactly were you feeling with respect to session, and any suggestions that you may have. So you can do that over there also. Mustafa Bilal, Imad Ahmed, thank you very much. Mustafa Bilal, you're asking, will we get a revision email from ACCA to learn the concept? Yes, yes, and these lectures would be uploaded on Vimeo, but the only difference on the Vimeo is going to be that I'm not going to be present. So if you attend them live, you get this benefit that you can ask the question then and there. Okay, anyone else has any recommendations, any comments, any feedback, if you could like to share, please? Okay. Muhammad Amin, inshallah, we'll do it tomorrow, the WhatsApp group. Imad Ahmed, sir, in practical withholding are of so importance. Yes, they are of very importance, but unfortunately, the scope of this webinar does not cover the withholding tax. The reason behind that is the guidelines that have been given by ACCA is to follow the ACCA F6 PKN variant. So for the withholding tax, I'll keep you posted that if I do things with respect to the withholding tax at a later stage. Okay, so thank you very much, everybody. Thank you for your time. See you all inshallah tomorrow at 8 p.m. the Pakistan Standard Time.